Hello and welcome to Tech for Non-Techies, the only podcast that demystifies the fast-growing technology sector. I'm your host, Sophia Matveeva, Chicago-based MBA and tech entrepreneur. My aim here is to give you the skills, knowledge and confidence to find opportunities in the tech sector, whether that's through founding a company, getting a dream job, or bringing a fresh perspective to your work. Hello, smart people. Today we're talking about venture capital, a key part of the technology industry. What you're about to hear is an excerpt of a masterclass that we had with a venture capitalist from Silicon Valley on Tech for Non-Techies. If you want to see the full session and if you want to join our sessions with our live experts, then just sign up to membership and then you'll be able to ask your questions and join the live sessions every week. But for now, without further ado, let's start class. So today we'll be talking to Nilesh Trivedi, a fellow Chicago Booth alumnus, who'll be talking to us about what venture capitalists actually do, how they work with founders, because I believe that they actually are supposed to give us founders some advice, and also how you transition into venture capital, because in general, and Nilesh, I'd love you to go into this in more detail, but in general, venture capital is not the kind of job that you get straight out of college. It is a career that people generally transition into after doing something else, and lots of people want to transition into it. So without further ado, Nilesh, tell us, what do you do today? So what is your actual job?
Well, happy to be here and thanks for having me. I'm expecting a fun conversation. It is definitely not boring, venture capital. And the reason why it's not boring is because it deals with startups, and startups cannot and should not be boring. I don't know of any startup that hasn't had a crazy day, especially the stages at which I typically get involved, which is early and growth stages. So it's always, either fun or either craziness. And as a VC, you kind of have to not just deal with that flow, but also participate actively or passively in that flow. What I do on a daily basis is mostly, I would say about 60-70% of my time is mostly spent talking to founders, talking to new companies that I haven't seen them. So it's either that or either trying to find interesting companies that I haven't seen them. And then the rest, 20, 30%, 40%, depending on the day, is spent on managing whatever is in the portfolio. The portfolio meaning the companies that I've invested in or we have invested in as a fund, and there are things happening and we got to pay attention to what's happening there. Some of it is actually helping these companies. It just again depends on the given day or given week. It's not necessarily that we are always actively helping our companies. There's actually a saying in our business that the best way for a VC to help is to not get that phone call from the founder that, oh my God, things are falling apart, I need your help. But that's on the extreme side. There's startups always need some kind of help, whether it's trying to find their go-to-market or saying, hey, I have this potential customer that, help me reach out to. And then over the last couple of years, it has become a bit more service-oriented, which means this whole notion of, how can I help? There's all kinds of VC memes out there about VCs always talking about how can I help, etc. I'm sure, you guys either laugh at it or are familiar with, which is true, which is, the way we try to differentiate. Because the rest of the stuff, capital to some degree is getting commoditized now, especially where we are today in the economic cycle or the venture economic cycle. There is a lot of capital available for startups. Things are founder friendly. So the only way we can differentiate is to actually show what we can do for these founders. And I would say show them upfront rather than getting into a relationship and then figuring out that this is not the right VC fit, for me as a founder, for example. So I spent a lot of my time just building my brand, building my firm's brand. That's one way to attract good companies to talk to us. I live and breathe around tens of thousands of startups in Silicon Valley and probably hundreds of venture firms. Many of them look and talk very alike. Um, so, so it's. I mean, I guess the right word is it's very competitive. In fact, it's extremely competitive. So just to you know start the business is no longer, or start venture capital fund or firm is no longer the case here. I think we've kind of moved on from that phase into saying, how do you actually stay relevant as a venture firm, even if you have had like 10, 15, 20 year history. So it's never boring for sure. And it's interesting primarily because you're always learning something new, and you're always learning something new because you are always talking to these founders and entrepreneurs who have been out there. They usually start their business knowing what they want to do, and they usually know what they are doing. They may not have all the answers while running their company at a given point in time, but they typically have a vision, and nobody can replace that vision as to how you as a founder see things, I guess, the future, than anybody else, which is why you start a company. You don't start a company because you saw something that you want to just fix for today. Hopefully you want to fix it today, and then fix 2x more tomorrow, and then compound that, or however you fix that problem and kind of develop a market, or solve a problem in the market that you are trying to solve.
So would you mind just telling us about your fund?
So the fund is called J Ventures. It's a $25 million early stage to growth stage fund. It does anything from seed to later stage, like D rounds, E rounds, F rounds. We kind of are a stage agnostic fund, even though it's a small fund. The reason why it's stage agnostic is because we are funded by close to about 300 or so LPs, or limited partners, who are our investors, or investors in our fund.
To clarify for the audience, venture capitalists are investors in companies, but venture capitalists also have their own investors. And those investors are called limited partners. And in the lingo, it's LPs, limited partners. So limited partners can be either just very wealthy people, or they can be other funds, or what else can they be? So tell us a little bit about your LPs.
Yeah, sure. So it starts off mostly with high net worth individuals. They could be, people with family money, or people with, who made money building their businesses, selling their businesses. There are all kinds of people, all kinds of people with money, obviously. So that is the non-institutional kind of capital. There is the institutional capital, which is, right from sovereign funds, which means funds at country level, like the Saudi Arabia fund, or the Netherlands economic fund. They are also institutional investors, but they typically invest large sums of money into venture funds or private equity. It's typically hundreds of millions of dollars. So if I was raising $1 billion fund, I would go and talk to those guys. And then there's like pension funds, the retirement funds. They have certain private equity or venture capital allocation as an asset class, just as part of their portfolio strategy. So they also invest in VC funds. Then there are family offices. So families that have been around, have these hundreds of millions or billions of dollars sitting there, and are investing. So the family office investment is also a big part of the people that invest in venture capital funds. And then the high net worth individual kind of also typically makes up for the smaller funds. Typically, the funds who don't have a lot of track record, like tens of years of track record to show that I invested in Facebook, let's say, back in, or Google when it was just starting. There are many funds right now that don't have that kind of track record. So they would go and raise from high net worth individuals. Our case is exactly that we decided to raise mostly from high net worth individuals because our fund, our principle, and how we differentiate is kind of predicated on that we get involved. And the way we get involved, even though we are a very small team, we get involved by virtue of getting our investors involved. So all of our LPs are actively involved in everything we do, which is typically not the case with other venture funds. You don't hear their LPs getting involved with the things that they do, and more importantly, with the companies they invest in. Most VCs tend to talk that they are the smartest people in the room. So when I say VCs, I'm talking about the general partners or the principals, the managing principals of the fund. We take a bit of a different approach. And again, that's by design, because we decided to get smarter than us people as our investors, so that when I come and talk to you that, hey, you're doing this consumer startup, I have zero experience of a consumer startup. I've never run a consumer startup. I've never worked at a consumer startup. So what makes me the right fit to invest in your company is by showing that I've got founders of Levi's as my investors. I've got founders of Estee Lauder as my investor. I've got founders of X, Y, and Z, protein-based health or skincare, women products. She's an investor in my fund. So anytime I see a company that I don't understand or don't think that I have the expertise in, I get my investors involved, and we show that as a fit to why you should talk to us. So that's I guess that's the key ingredient or the secret sauce of us leveraging, the intellectual, I guess the collective intellectual of not just, me and my partner or, our associates, but it's this 300 plus people that could be across all kinds of sectors.
So I'm curious about this journey of, okay, so your life.
My background was basically an engineer, or I guess, let's call it like a techie, turned product guy. So a little bit of business or operator kind of aspect to it, turned into a VC. And that is, I guess, wasn't really by design or anything per se that I had, when I graduated about 20 years ago, that this is what I will do. It happened naturally because either I was starting a company or thinking of starting a company. The goal was always that the goal was to figure out, like I said, to build companies or help build companies, however you want to frame it. And my thesis, as well as my approach, was to get involved at earlier stages so that I can be a part of that process. I can use that process to go and build, bigger things. And while in that process, I figured that the one, impediment to building, why not just, doing one, then I did two, and then I did three and four. And then I was like, okay, I only have enough of my own capital. I got to go figure out how do I find more capital. And then I wasn't really sure whether I want to manage the logistics of a fund, because it's almost a 10-year commitment. You plus maybe another 2 years or 3 years, so 13-14-year commitment, even with just one fund. And it's a 20-30 year cycle, just to be good at this game, right? If you're not good at this game, you don't exist in this business. There is no mediocre, I guess, possibilities here. So I took the approach of saying, look, before I do all that, my goal is just to build companies. So then I kind of took the route of, doing a fundless kind of a vehicle where I didn't really go and do a fund, but I had investors who I would go and invest with or invest for in companies, more than just 25K check, maybe
like
maybe $1 million check. Yeah, maybe like $1 million check. But what happens is, look, there's only two ways to make money in this business. One is either you get exits and you earn your carry, so the 20% profits, and you You figure out what that is, and the management fee. The management fee is, by the way, small fund venture capital is not very lucrative. The math is when you actually do the math, you realize that VCs, typically early VCs, or funds that have been only around for the 4 or 5 years, they aren't actually rich people. And the math is very simple. If it's a $50 million fund, I have maybe $1 million to spend on a yearly basis on doing stuff. Maybe a team of 2 people, 3 people. So you aren't looking at VC GPs who are making like millions of dollars. It's not lucrative at all.
Shall we explain? I mean, I know the math. I used to work in a private equity firm, which the carry works there. So basically, for people watching, the way a fund would make money is what you would have called it's a management fee, and then from when a company gets sold, a management fee is basically a percentage of the money that investors give you to invest in companies, but you take a percentage of that, and essentially that's your money to keep the lights on. So the percentage used to be just in general 2%. Sometimes it varies, but 2% is average for private equity and for venture capital. So what Nilesh is saying is that when you have a really big fund, so imagine you've got a big private equity company and they raise $1 billion fund, and then their management fee is 2%. Okay, well, with that, you get an office in Park Avenue and some Rodin sculptures and, I don't know, trips to the Four Seasons. Or then if you literally take the same math, but you're a young venture capital fund with 50 million, then it's going to be a smaller office and posters of Rodin rather than the actual posters, rather than the sculptures. So that's one way to make money. The other way to make money is when the company that you invested in gets sold. But, Nilesh, I'd love you to tell us the maths here, because the companies actually being sold successfully, it doesn't happen that often. It's about 1 in 10 chance? Tell me.
Yeah, I mean, it used to be that few percentage points, and that's, I would say, maybe 10 to 30% of portfolio does well. Less than 10% does incredibly well. More than 20-30x returns. I was going to say, some of your listeners would kind of think about joining a fund or starting a fund. You just, for the first 5 years, 6 years, like me, you have to just survive by other means. The management fee, or it's just so tiny. And by the way, raising even a $50 million fund for an emerging manager or a first-time manager is just almost impossible. So you're looking at maybe 5 million, 10 million, first fund. Second fund might be 15 million. So the first 5-6 years, you're maybe looking at earning 300-400K per year. And in that, you have to do everything, like, basically manage your deal flow, manage everything. So it's not very lucrative, by the way. You do it mostly for, with the vision that you want to end up building an Anderson Horowitz or a Sequoia Capital kind of a firm in the long run. Or you do it for the passion of, like I said, for me, it was the passion of building businesses. The financial part of me, I didn't come from that background, fortunately, where it wasn't really, it excites me, but I could probably go and work at Google and make $1 million, maybe even more, right? But why would I kind of do this where, I'm not even doing like, 100K in salary, but I'm doing that because I like the whole idea of finding something, I guess, in the rough, and then polishing it. And then suddenly it's a diamond, that is valued at whatever X number. That's the passion that drives most of the new fund managers, in my opinion. Most of us don't do this because we know that, oh my God, I'd be driving, the next Porsche or whatever. Most new fund managers are incredibly hardworking, are very modest, just because this is like our own startup. We don't have a whole lot of money, that my investors have given me to slosh around, to sit there in the office. I actually don't even have an office, by the way. I work with another venture fund who has $400 million in capital, and I'm like, can I use your office? so, so it's again, just like a startup, you're playing for the long game. You're hoping that you end up, just a startup expects that it ends up becoming $1 billion company. I think us VCs are also hoping that we become like that. Now, once you're the brand, then you can afford to kind of I guess the brand speaks for itself. Like nobody would not want to take money from Secure Capital or Benchmark or Anderson Horowitz or Excel Partners in London, right? But I would say right now we are living in a world where there are a lot of VCs out there, new VCs out there, who are working very hard just to build their own funds, their own firms, and founders and want to just help these founders just go and do incredible things so that they can see that success, because I am nothing without these founders being successful.
Well, I have made my biases very clear on Tech for Non-Techies before, is that I think for especially earlier stages, but I think for founders, investors who have had experience in creating something, they are generally the people that you want to work with. And yes, of course, there will be some exceptions. But in general, somebody who is brilliant at working with a spreadsheet, but has never actually had to hustle, has never actually had the operational experience, that's not a person who is really going to be that helpful on a journey that's really quite rocky. And also, I think in Nilesh's experience, that we can see that there's real technical prowess that you bring. I think not every single investor needs to actually have a deep understanding of technology, but they need to have a deep understanding of something. So, I've worked with investors who are really good at understanding marketing. And yet they won't be able to look through the tech stack. But you know what? I mean, the technology I build is much more simple than the frontier tech you're talking about, but actually reducing marketing cost and having interesting marketing campaigns that essentially mean that you can have low marketing costs, which means you can have high profits. Like, that's something I'm really, really interested in. So build up your experience in actually something that can be useful to a tech startup or a tech-enabled startup. Get involved, and then you're going to be the kind of investor that people want to work with.
Wasn't that just so super useful? If you want to join sessions with people like Nilesh and ask your questions, then we have a class every single Tuesday, and each class is an hour long, and you get to join, you get to ask your questions, and it is much more than just listening. It is a full-on masterclass and a Q&A session with an expert on technology. And that's just one of the awesome things you get in a membership. You also get a community, you get coaching sessions with me, and you also get a whole library of interesting content and also special offers on all of our courses and my books. So basically, what is not to like? So check out Tech for Non-Techies membership, and I'll see you in class.